Consider these two young adults, Camila and Daniel. They're both 30 years old, employed, and earn the same salaries. Camila has $20,000 in federal student loan debt and $250,000 in mortgage balance. Her total monthly debt payments equal $1,642. Daniel has credit card debt of $25,000 and an auto loan balance of $60,000. His total monthly debt payments equal $1,403. Both have sufficient income from employment to make the monthly debt payments. What do you think? Does their consumer debt put them in the same financial circumstances both now and for the future? Well, it depends on your attitude towards personal debt. Do you believe all consumer debt is bad? Is there a difference between good debt and bad debt? Hi, I'm Harry, and welcome to this Starn Standard Practical Knowledge video. During this video, we'll explore consumer financing and debt management. Specifically, the topics covered in this video include the psychology of consumer financing, good versus bad debt, the 3 C's of credit, the types of consumer debt, typical uses of consumer debt over a person's lifetime, and debt management strategies. This knowledge will help you make informed decisions regarding consumer financing and equip you with strategies that you can apply when managing your debt. In subsequent videos that are related to this piece of the personal financial planning puzzle, I'll go into much more detail on understanding the FICO credit score, selecting the best credit card for your situation, managing your student loan debt, understanding the characteristics of revolving credit, lines of credit, and installment credit, and managing your existing debts and prioritizing debt repayments. Consumer financing refers to the decision of whether to take on personal debt to fund immediate acquisition of an asset, a consumer good, or a service. Examples include purchasing a car, a family home, durable goods like a washer and dryer machine, tuition and fees for education, vacations and travel, unexpected expenses, clothing, and entertainment. So, what do you think about taking on debt? Some advisors suggest delaying purchases until you can fully fund the acquisition with cash. Clearly, accumulating debt has financial and psychological circumstances. According to Forbes, their study shows 54% of respondents shared that they were always or often stressed with their debt situation. But is delaying the acquisition the best decision for your today and for your future? There are numerous factors to consider, including the necessity or urgency of the purchase, your financial situation, and ability to make the required debt payments without falling into any self-sabotaging debt cycle, your tolerance for risk, and the impact of acquiring the asset for your future wealth accumulation. That last variable, impact on wealth accumulation, is typically the reference point for categorizing debt as either good or bad. If the consumer debt allows you to acquire an asset that's expected to either generate future income or capital appreciation, then it might be considered as good. Examples include the home mortgage, education loans, and business loans. If the consumer debt is used to acquire an asset that depreciates in value or requires ongoing cash outflows, then it might be considered as bad. Examples include credit card debt, used to acquire non-appreciating goods, retail store credit cards, and car loans, particularly for luxury cars. Okay. Let's revisit the two young adults that were introduced at the beginning of this video. Camila has $270,000 of consumer debt, which was used to fund her college education and purchase a home. Daniel has $85,000 of consumer debt consisting of credit cards and a new auto loan. At first glance, it appears that Camilla's debt situation is significantly worse than Daniel, based on the amount of the debt outstanding. However, look at the use of the debt. Camilla used consumer debt to earn her college degree, which hopefully positions her for significantly higher lifetime earnings, and to purchase a home which is expected to appreciate over time. Additionally, qualified student loan interest can be written off as an above-the-line adjustment on her tax calculation. And mortgage interest and property taxes can be written off as a below-the-line deduction. In contrast, Daniel has non-deductible, high-cost credit card debt and a non-deductible auto loan. His use of consumer debt was directed at assets that will decline in value. The use of the debt changes the evaluation. Now, what about the cost of that debt? How can it be that the two monthly payments are so close given the significant difference in the total loan amount? Well, it comes down to how lenders evaluate the safety of the repayment and how that safety, or borrower risk, is priced. This is sometimes referred to as the 3 C's of lending. After using the market rate of interest as the starting point, lenders adjust the cost of the loan, the annual percentage rate charged, based on 3 variables: the borrower's financial capacity, collateral backing the loan, and the borrower's character. Financial capacity refers to the borrower's ability to repay the debt based on an assessment of debt to income or some other similar measure. For example, the CFP board suggests that a person's housing-related debt payments, which includes principal, interest, property taxes, and homeowner insurance premiums, do not exceed 28% of gross income. When combining all the consumer debt payments, including housing, auto, school loans, and personal loans, the board suggests that the ratio does not exceed 36 to 38% of gross income. Lenders have their own set of measurements when evaluating the loan request. The second C refers to whether there's any collateral backing the loan. For example, a home or a car that's pledged to the lender are examples of collateral. If the borrower defaults on making the loan payments, then the lender will repossess the asset, sell it to recover their outstanding loan balance, and return any remainder proceeds to the borrower. The third C refers to the character of the borrower. A lender wants to see the person's credit and repayment history because it offers a verifiable record of the person's resolve and attention to detail with repaying debt. The FICO credit score is used as a proxy of character. When the potential borrower rates high in each of these 3 categories, there'll be more lenders willing to extend the loan, and the loan quote will be at a lower cost. In our 2-person scenario, Camilla's annual rate of interest on her federal student loan debt and the home mortgage are drastically lower as compared to the high cost of Daniel's credit card debt. There are 3 categories of consumer debt, which may be available depending on the borrower's situation. First, open or revolving credit, for example, credit card. Second, closed or installment credit, for example, an auto or an appliance loan. And third, a line of credit, which is sort of a hybrid between open and closed credit, for example, a home equity line of credit or a personal bank line of credit. The applicable interest rate, the terms and conditions of the loan, and other applicable fees vary depending on the lender and the borrower's situation. I'll address the characteristics and types uses of these debt securities in a separate video. The lifeline shown here depicts the typical forms of consumer debt financing over a person's lifetime. When attending university, the young adult may need access to student loan debt and make use of their own or a parent's credit card. After graduation, or for those opting a different path than college attendance, consumer debt takes on added importance. The early career is characterized by low earnings compared to later career, and the need to accumulate assets, including a car, home, consumer goods. If student debt does exist, then this is a period in which loans are usually repaid. As the career progresses and the earnings increase, many debts have been paid off. However, new debts might include financing of a new home, financing the education of the children, and home equity loans. Notice how the use of credit cards spans the entire lifeline. Debt management refers to the process of organizing and keeping the record straight, making timely debt payments to avoid any penalties or default, minimizing overall cost, and prioritizing early debt repayment. Your informed management of consumer debt can have positive cash flow implications, including lower monthly payments and lower total interest paid. Strategies for managing debt repayment cash flow and total costs of the debt include refinancing the current mortgage at a lower interest rate, a mortgage refinancing with cash out, where the additional cash is used to pay off other existing debt, like credit cards, liquidating higher cost debt with a new, lower cost debt consolidation loan. For example, taking out a home equity loan to retire existing credit card and auto debts. Accelerating the number of debt payments during the year, which will retire debt earlier and reduce total interest payments. And initiating a credit card transfer, where the existing credit card balances are transferred to a new credit card with a lower rate of interest or a low teaser rate, which is a rate available for a brief period of time. Let's go back again to our opening scenario and consider Daniel, who has a credit card debt and an auto loan. Given that he received a bonus from work and he wants to use the extra income to pay down some of his debt, then which account should he pay off first? This takes us to the topic of prioritizing debt liquidation. Several factors come into focus when determining which debt account should be paid off first. Those factors that need to be considered include the cost of the debt, the interest rate, and any prepayment penalties that might apply, the flexibility of the debt payment. For example, is there a fixed payment due every month, or is there some flexibility in making the payments? The tax status of the debt, if the interest is deductible. Has any property been pledged as collateral for the loan? And the balance of the debt. Note that paying off small debt balances can create momentum, a positive sense that you're making progress, and that is valuable. Well, in this case, Daniel will most likely try and pay off the credit card debt for the following reasons. The interest rate on the credit card debt is substantially higher than the auto loan. Neither loan offers any tax breaks. Daniel's income is sufficient to cover the fixed car payments, so retaining the flexibility of the credit card payments is not a major issue. Realizing the issues, you'll be able to make an informed decision on prioritizing the early retirement of your consumer debt. In this video, you learned about numerous issues you need to consider when determining whether to utilize consumer financing. The impact of consumer financing on your current cash flows and future wealth accumulation. The 3 C's that lenders consider when determining whether to extend the loan offer. 3 categories of consumer financing: revolving, installment, and lines of credit. Typical uses of consumer debt throughout the life cycle and debt management strategies. Well, thank you for watching. I hope you enjoyed this practical knowledge video on consumer financing and debt management, and that you can immediately start to apply the knowledge to your current situation. If so, please let me know by clicking on the like button and by subscribing to the channel. You might also check out other standard videos that are related to this important personal financial planning topic. Have a great day and see you at the next video.